The chat box is live on LinkedIn. Please feel free to throw any questions in there. We've assembled the MetalMiner team. We're looking at the key markets today: aluminum, copper, stainless steel, and hot rolled coil, plate, etc. We'll show a few extra things as well. There's a lot to discuss. There's a lot going on. And at the end, we'll kind of wrap with a little short Q&A. If you've got any questions, to throw that in again into the chat. We'll also point you to some free resources that you can take advantage of. Next year, we're mixing up our webinar program. We're going to move to quarterly webinars. So we'll miss you from a monthly perspective, but you're still able to see what we're doing and follow along with us by using our newsletters, and you can sign up for that as well. Okay, so with that, I'm going to start with our give you a little bit of an economic overview here. So I'm pulling up and just want to confirm, can everyone see my screen? I think no. Let me move that over. Here we go. Let's start with some of the economic background here. I'm showing you a CRB copper chart, and the reason I'm showing it is just because I think it's interesting to see how both have moved historically. And as you can see, they've followed a very similar trend, kind of up high over here, way back, going back to 2013, down to 2016. And you can see it's been sort of flat. And then the big rise, which is post-COVID, et cetera. And then here you can see where the CRB has kind of fallen into a higher sideways trend, but also at the same time, copper's moved into that sideways trend. Even though these look like they follow one another fairly closely, when we do a correlation analysis, we see there's only about a 59% correlation, which we do not view as particularly high. But I like to show that because people like to use the CRB as sort of their what is the word, gatekeeper in terms of what the market is doing. And then copper, of course, gets known by the name Dr. Copper. What's more interesting, and I know Nicole will go into this in greater detail, but this is a comparison between copper and hot rolled coil. And I like to share charts like this because there is fairly similar movement in the two. And I know there's a lot of, we focus on these two metals because copper, again, the bellwether for the economy. A lot of organizations, a lot of OEMs look at copper as their sort of economic bellwether. And, you know, if you're looking at this and you're saying to yourself, yeah, it's kind of sideways right now, that's definitely what we're seeing. I'm going to speak for myself, a little more bearish than maybe a couple of us. There are some maybe glimpses of economic activity that look positive for 2024, particularly around government spending, which my colleagues will talk about. But I look at this slide as also, you know, copper. There's some analysts out that are already talking about $10,000 a ton copper. We're super skeptical of that, and that's mostly because we're seeing kind of a demand fall off. Anecdotally, in my conversations with bankers, we're starting to see the consumer is beginning to really struggle. So a lot of that COVID capital that they had, you know, in their pockets has been spent. There's a lot of borrowing now. There's more defaults, et cetera. So that's why, from an economic perspective, I'm a little bit bearish overall. I think the piece that everyone has been so excited about, there's been, if I was to say what metal has everyone been so excited about, it would be lithium. But I just wanted to share with everybody what lithium is doing. It's not a pretty picture. I'm just kind of stretching the graph a little bit, and it's continuing to fall. So what is lithium? Lithium is a good bellwether for some of the you know, EVs and other, you know, demand for that kind of material. This is, of course, a you know, a global, you know, lithium is used, basically priced in China or priced in South America and used globally. But I think it's telling us that bear story. So with that, you know, I guess from a summary perspective, you know, I think we're seeing, and I know other economists like ITR are calling for a sluggish to recessionary 2024. There's some debate internally in the MetalMiner team whether or not that will prevail for all of 2024 or just the first half. I know it's kind of conflicting because we've seen, you know, 5.3% GDP here in the US. this last quarter. It's hard to fathom that we're going to go from 5.3 to minus something. And again, recession is really defined as 2 quarters of negative growth. So whether or not we actually see recession in Q1, what we're likely to see is the more dramatic slowdown. In our own conversations with companies, we're hearing and seeing more discussion around high inventory levels still. Although some things have burned off, we're still seeing manufacturers with pretty significant inventory builds that acts as a drag on metal prices. So with that, I'm going to kind of pass the guard over to my colleague, Stuart, who's going to talk about aluminum. But again, I want to encourage you all to just feel free to throw questions in that chat box. And with that, Stuart, I'm going to stop sharing my screen, or rather maybe just flip over to aluminum.
Okay, thank you very much, Lisa. Well, what a difference a year makes. If you look back to this time last year, the whole supply chain was struggling to get metal. Logistics were still recovering from the post-pandemic bounce back. Prices were much higher. Premiums were way higher. Everybody was making so much money. But as the logistics supply chain began to recover, and as manufacturers caught up with demand, the cracks began to show in the market in the first quarter of this year, and prices began to slide. And if we look at the LME price, for instance, over the last 6 months, it's been range bound, really range bound. It's been trading between 2,100 and 2,350, averaging around the 2,200 mark. But interestingly, I think what has been happening is that the delivery premiums, Midwest delivery premium, the Rotterdam delivery premium, have been coming off. And that's generally a sign that demand is weakening. The LME price has been supported by energy prices, by the loss of Russian metal in the market, and so on. But the Midwest premium is telling us a story that demand has gradually weakened, and there is now inventory everywhere. And although the US has been the standout performer globally over the last 12 months, it's maintained a strong level of growth. Europe has been in manufacturing recession for at least the last quarter or two. China is really slow. Consumer demand in China is slow. And inventory levels remain really high throughout the supply chain, the aluminium supply chain, particularly in Europe. And we're not only seeing the Midwest premium coming off, but we're seeing billet premiums down 30%. The automotive sector is down in Europe and is looking weak in the US. Construction is down. Constellium just reported their figures recently, and they're reporting both construction and packaging is down. Machine tool sales in Germany are down. I know I sound very bearish, but I think the result of that is going to be that prices remain under pressure for at least the next 6 months of 2024. And most manufacturers in Europe and Asia are not expecting much of a recovery until the second half of next year. So as a result, I think we're looking at a short-term sort of forecast of between 2150 to 2320 for aluminium. That's pretty much where it's been over the last 6 months. We're not seeing any significant change into the early part of next year. Our longer term forecast is more 2100 to 2390 sort of level. As you can see, there's more to the upside there. That's reflected more, I think, in the latter part of the year. What does that tell us for our buying strategy? What should we be doing in a market like that? Well, now's a good time to be fixing premiums. Conversion premiums have come down a lot. Buyers have the whip hand in terms of negotiating with suppliers to try and fix competitive conversion premiums over the coming month or two. And it would be good to fix for 2024 conversion premiums, I think, at the current level, but not to fix underlying metal prices. I think there's another 6 months of weakness, and we can buy at fixed conversion premiums over floating LME for at least the next 6 months, and then take a view to what the second half of the year is going to look like. Whether or not there's a recession in the US, I don't think is the deciding factor. The market is definitely going to get weaker in terms of demand. I think that's probably about it for aluminum, unless anybody has any questions.
Again, I want to encourage everybody to throw any questions you have in the chat. And with that, I will stop sharing my screen and turn the mic over to you, Nicole. I'm going to remind you you're on mute. And you can cover whichever metal you prefer, copper or stainless first, doesn't matter. So,
all right. One moment as I share my screen. All right, I'm going to begin with the stainless market. Hopefully everyone can see the 304 NAS surcharge. And if you'd guess that it's in a downtrend, you'd be correct. Hopefully that's obvious to everyone. The market remains quite bearish. There's a lot of key sectors that have withheld purchasing during H2, including food service equipment, which feeds a lot of demand. Inventories currently remain at normal levels, but in a bearish market and with falling prices, that's not going to offer any support to price. In terms of pricing, base prices continue to hold flat since January of 2022, which has left only the surcharge in decline. There's a lot of reports of transactional discounts depending on orders. And there's also reports that mills hope to increase base prices next year, but it's unclear that they'll be able to secure that amid the bearish market. And part of what's driving the surcharge lower has been a significant decline in nickel prices. I'll flip over to that. That's been in a really strong downtrend throughout the year. In fact, it's been the worst performing base metal this year. We've seen a 46% year-over-year drop. Although mills use scrap as part of their mix, secondary nickel, they price based on LME prices, and that's been incredibly bearish. And there isn't really much of an indication that that's going to change. Indonesian production remains quite strong. There have been discussions that they might be forced to start cutting that production, but that hasn't necessarily materialized yet. And so that'll likely continue to pressure prices downward. Much of the production has benefited Class 2, but there's been a lot of efforts made to convert some of that material into Class 1 nickel, which is what would be represented with LME prices. Like I said, the bearish pricing could lead to production cuts, but it hasn't happened yet. So in terms of next year, in a short term, Q1 is typically a seasonal high point for demand. One distributor noted that there has been an increase to quotation activity, but the caveat to that is that there's been no actual increase to purchasing activity. Like I said, mills are hoping to increase base prices, and they've tried very hard to lower production levels throughout the year. The last data showed that there was a 13.5% drop during the first half of the year in stainless melt shop production in the US, and that trend likely continued during the second half. Q1 could see a slight increase, but largely the market has remained quite bearish. And with the surcharge in decline and no indication that nickel has done even move sideways, it's very bearish. People will likely buy only in incremental amounts and limit any purchasing, which would offer support to prices. So like Stuart said, with the aluminum market, I remain quite bearish from both a long-term and short-term perspective when it comes to stainless and nickel specifically. I'm going to move on to copper prices. As Lisa said, we look at copper. It's often a bellwether for the economy because it's used in so many different sectors. And unlike nickel, this has been pretty flat throughout the year. We've seen year over year.
Nicole, you've muted yourself for some reason. Could you just take your mic there? And could you repeat what you said? Go back about 30 seconds.
Okay, where I started with copper?
Yes, please.
Sorry, I don't know what happened there. So copper, it's been pretty flat year over year from where it started. There's been a very modest year over year decline from where it started, 0.19%. So compared to the 46% decline in nickel, that's a very big shift. And while there's been a lot of reports recently that it reached a 4-month high, it's still trapped in its sideways range. We haven't really seen any significant breakout that would indicate an uptrend. I mean, that's a very flashy headline, but it's not really indicative of any kind of bullish market, far from that. Currently, prices have sort of stagnated. They're falling between their April high and their October low. We've seen support from China and specifically the renewables sector. They've reported strong imports, and the Yangshan copper premium, which is a proxy for Chinese import demand, remains up. It's actually more than quadrupled since March. But there's a lot of risks still to the Chinese economy. The renewable sector was one of the sectors that received a lot of stimulus measures, and that has helped compensate for downturns elsewhere. But like I said, there are big risks, including the unprecedented declines in the property sector. There's deflationary pressures, and there's been a strong pullback in foreign investment with no indication that there's going to be a shift. In the US, there's also a lot of renewable spending ahead. Grid spending specifically will benefit copper. There was a big round of stimulus announcements and awards in October, and there will be more in January, but there isn't a clear indication of when those projects will begin. Oftentimes there's a significant delay between the announcement of funding awards and when those begin and when those start to hit the market and see support to something like copper prices, and that may take a long time. There's also some wind projects that are in the pipe for 2024, which will offer support. But what I would say with wind is it's not going to materialize like many people had forecasted. We've seen a lot of cancellations, and we've seen a lot of delays that could very well turn into cancellations, with a lot of pricing pressures being attributed to why it's no longer an investment that companies are willing to make. So more than anything, there's a lot of demand headwinds, and if the U.S. does continue to face a downturn, that will limit the impact of any investment from the government. We're also watching very closely what's happening with the dollar. I'm going to flip over to that screen, and you can see that, like copper, it's been quite flat. And so it hasn't necessarily had any big pivotal impact on directionality in terms of currently sideways copper prices. The dollar watches Fed moves, or markets watch Fed moves. So after we saw a decline in the CPI, markets started to bet on a Fed pivot. But however, there's not really been a shift in tone from the Fed. If anything, they've continued to tout a restrictive approach, and they're going to continue to watch the data that comes out, including GDP, which was robust in the third quarter. So beyond that, I would say currently interest rates are at a 22-year high, and that's going to continue to pressure the economy, including manufacturing, which is going to provide a very, very strong headwind to support from other sectors. And so the outlook right now is that it'll continue to move sideways, and we'd like to see a break above, I'll go back to copper, we'd like to see a break above its previous highs or its previous lows to indicate a shift in trend. But like other base metals, it'll probably reflect a similar situation. And if other base metals are going to be down to muted, then copper is likely going to indicate the same sort of trend.
Great. Is that anything else to add, Nicole?
I don't think so.
Great. So before we kind of switch into Don's commentary on steel, just kind of a mention, you saw these support and resistance lines that we talk about, and just kind of want to give a quick overview. How is that relevant for a buying strategy for 2024? So when you think about those support and resistance lines, we project a 30-day range that we expect the metal to trade. And so when Nicole, you were talking about, that if the metal goes above the red line or above resistance, that's when we know that there may be a shift in trend. And so it could be a short-term shift, a short, 30 days to a quarter, or it could be a longer term shift. And that would be the bands on the sides, and which are typically those longer bands. So that's kind of how we look at the market, and why, I think everything, Nicole, you've said is kind of dovetailed with what we're seeing in the general economic data. Some things have fallen flat, but a lot of things are just sort of kind of swimming sideways. So with that, Don, maybe you have something different to tell us. I don't know. But if you will, we'll kind of move on to steel.
Sure. Thanks, Lisa. So I'm going to cover kind of the news in general, the tabloids or headlines, I suppose is the right way to say it. That's the fun stuff that everyone likes to talk about. I'm going to hit hot rolled coil domestically and how it relates to plate and scrap and some other products. And then I'll end with plate, kind of a wrap up on plate. It's sort of a culmination of everything that everyone else said. If you look at kind of the markets in general, they kind of weave into steel bits and pieces of them. The big one, obviously, for hot rolled coil in the news is the U.S. Steel. What's going on with the U.S. Steel? Is it going to get bought? Is it going to get bought by Cliffs or ABCX Mill? Nobody really knows. There's indicators that it will definitely be sold, and then the counter is, well, that obviously indicates that it's not going to be sold. So it's kind of all over the place. My personal view is Cliffs kind of initiated this process, and at the end of the day, if Cliffs wants to buy it, they're probably going to buy it. I think if the economics of the deal work out, they'll do it. There's a lot of talk about too monopolistic, and will it pass scrutiny with the government? A lot of people, especially in individual segments that use specific material, nose, stuff like that, kind of will super consolidate some of those. Think, well, the government would never allow that to go through. I'm of a different opinion on that. When you look at some of the manufacturers that have lobbying arms and that would not want that deal to go through, I don't know that they have all that much pull. Mills have large lobby arms themselves and have been very effective in consolidating the market despite end users' objections to that consolidation. So I don't think there's as big a legal hurdles as you might see in the marketplace. So it's still to be determined, will that happen or will that not happen? There will definitely be consequences if it does. I think maybe more so on the sentiment than the actual consolidation, at least in the short term. It'll strike kind of a panic in buyers, and that's what the mills want. They kind of feed off of that to drive prices up. Whether the consolidation and the reduction of actual tons in the market is real or not, that doesn't really matter. It's driven a lot on sentiment. We've talked about sentiment versus supply and demand curves, especially in steel, at length. That's why we forecast the way we do and look at the indicators we do, not just straight as supply and demand curves. So that's kind of out there. If you look at what's going on with current announcements, Cliffs again kind of kicked that off. Hot rolled coil, we're not selling that at less than $1,000, and then Nucor followed with 1,100. And I think Nicole, you pointed out there was an announcement from Cliffs yesterday. I think that now they've followed Nucor to 1,100 min, that they're not selling hot rolled coil below 1,100. That's not really how it works in real life. So, I mean, they can say that's the min, but the reality is they sell what the market bears, and the market doesn't bear 1,100. I'm not talking to anybody that is chomping at the bit to buy a ton at $1,100. It's just not out there. So some of it sticks, some of it doesn't. That's how we've gotten off of the bottom. If you look back a little bit, we were 650, 660, somewhere in that ballpark, and it's really kind of ramped up. You're short of $1,000 a ton now, and it's through the headlines. It's through these price announcements, and then you had the end of the UAW strike. So obviously I mean, the UAW goes back to work. There's just going to be this massive demand for all the steel to make the cars. In real life, they pulled all that ahead already, and there was tons of cars sitting on the lot. So again, the headline versus reality is kind of two different things, but it stirs up that sentiment. So you get people that are going to buy some, especially people that aren't on contract and they don't have guaranteed availability. They'll go out and buy some of that, which drives some of the index prices up, which pulls everybody that's on contracts up. It's kind of standard practice. So that's kind of what I see for headlines out there. If you look at the economy as a whole, the demand as a whole, what's going on in general, I would kind of echo Stuart's comments about a general decline. Consumer goods, appliances, autos, all those things, I see that being soft into next year, probably most, if not all of next year. I think anything that you need a loan, anything that needs to be financed from the consumer is going to take a hit. So if you look at cars, I think one of the best interest rates on new cars is close to 4%. People are used to that being zero for 72 months. That's not really out there. So that's getting more expensive. If you look at appliances, things of that nature, home remodels, home starts, home sales switching, that stuff is all really depressed also. Again, the interest rates, there's a couple different things in play there. The interest rates are making things more expensive. And then the life cycle of those products, like, it's fairly new. If you look at all the COVID spending, a lot of remodels, appliances, things like that drive a lot of steel usage are pretty new. People refreshed those already. So there's kind of a vacuum in the demand pipeline there too. The bright spot that I do see is to Nicole's point, some of the wind, energy, grid, government spending. No matter what people's personal pocketbook is, the government always seems to find a check to write to somebody. That's not going to stop anytime soon. Upgrades on the grid, some of those wind projects, yes, there was some that were delayed and some that were canceled, but there will be some that get built. The coffers kind of regenerate in 2024 is my understanding. So some of that will hit, that will impact the plate market more than hot rolled coil. I think the last estimate, those wind towers use somewhere around 500 tons of plate material. And if you look at wind towers going up, they're getting bigger and bigger also. The fins or the blades on the windmills, those are getting bigger. So they're continuously using more material too as those get built further out. So that's kind of what I see for the market update as it relates specifically to steel. And then I'll jump into kind of more of the specifics. If anyone has any questions, just fire that out. So here we're looking at hot rolled coil as it relates to US, Europe, and China. If you look historically, they kind of all go in a pack. Obviously, the US one bumps up because we have different things in play that allow mills to kind of push those prices around. You shrink that a little bit here. You see some distortion, so it kind of stopped moving together. China is down considerably. I think Nicole talked about some of the things that go on there. If you look, one of the interesting things that I wanted to point out is the Europe number and the US number is kind of started to come back in line this year. So the ups and the downs with the Europe number are starting to come back in line. That's probably more market stability as a whole. So things are moving more as they're supposed to, as opposed to this craziness up here. But in general, China kind of sets the floor on a lot of stuff. And I understand that China hot rolled coil doesn't land here, but it lands somewhere. As that gets pushed out, I always kind of try to relate it to water. It will find the lowest point, and that's what happens to steel. It goes country to country, and eventually it will pull numbers down in here. So I think if you just look at overall trends when China has been this low for this long. If you take out some of the news bits or some of the extra sentiment driving things that will pop stuff up like this, we were on a track to everybody to kind of come back in line with this kind of group pattern here. And I think that will materialize again. So that's kind of what's going on with steel as it relates to different groups. Now, if I move back into more US Central, I like to look at lead times. Lead times tell the real story, in my opinion. If you're 4 to 6 weeks, you're really tight on lead times, especially in that 4 week. That means there's really no steel going out if you can get it in 4 weeks. 6 to 8 is really fairly normal. You start getting above 8, 9 weeks, then it's tight. You know, you can see some of these peaks over here. You're up over 10. And if I would have laid the price curve over there, it was really expensive too. So you had this kind of double peak here, and it looks like lead times are maybe starting to come back in line. So that indicates to me that there was a squeeze. They got some price out of there. The mills being they got some price out of there, wrapping up their annual contracts. It's always in the mill's favor to have a higher price going into the end of the year to leverage those contracts. And now I think you're going to start seeing some reality set back in as we move forward, those lead times. If we look at the actual price, it's this, you see these big bumps. That's not market movement. Markets don't really move like that unless there's something abnormal going on. And I think you're seeing that. This is again what I'm talking about. We were 668 at the trough down here. I know a lot of people were doing annual contracts in that time frame and saw some really good numbers. I know people got fixed deals for next year in the low to mid 700s for sure. So that's, that was out there. I think there was some panic in the mill. You got the consolidation with the US Steel story going on, and they were successful in pushing price back up. I don't know how much farther that is really going to go. We have short term at about $1,000, which feels about right to me. Also, if you look at the week over week increase in prices, it's getting shorter and shorter and shorter. Smaller, maybe is the right word. As that gets smaller, it kind of indicates you're coming up on a peak. And I think that $1,000 range is probably about it. There's always weakness going into the end of the year in December with the shutdowns for the holidays, for vacations. Publicly traded companies like to get stuff off their books for inventory. All that kind of slimming down usually creates a softening going into the end of the year, and then you see it pick back up after the first. That's probably going to be the case here too. I think people are going to look around and see kind of overbought here. That's usually what happens when there's a steep uptick like this. There's some overbuying and some extra inventory, and then it has to bleed off going down. First quarter is usually fairly strong, so I don't know that you're going to see a giant drop off immediately, but for all the other factors that I mentioned earlier, a general softening, I think it will come down. There will be a softening going into next year that will probably last most of the year. First quarter is usually the strongest, so the decrease might be the least in the first quarter, and I think it probably tapers off pretty significantly thereafter. So that's kind of the hot roll coil outlook. I always like to show what is plate doing and what is coil doing. We all know forever it did the same thing and then it didn't. Up here you have some of the government spending again that propped a lot of this up. The grid stuff, wind infrastructure, all those projects really kind of kept it elevated, and now it's coming back down. So it's going to probably keep sliding unless there is that opening up of government spending, which it kind of looks like there could be some of it. I don't see it coming back up. I think best case scenario for plate is it kind of gets flatter, and if there's enough of the government spending and projects, you can get it to kind of taper out throughout the year. I think plate is probably in a better position than hot roll coil in general. If you look at bridges, infrastructure, wind, all those type of things that are a lot more recession proof. It doesn't take a consumer to fund a bridge project, for instance. So I think they're in better shape, but I wouldn't say great shape. And then I have the scrap down here at the bottom. I always like to show how stable scrap is in comparison to everything else. If you're looking at contract structures, if you're looking at, should I fix, should I do scrap, should I do any of that? I really think at this point, if you didn't do your contracts kind of back here when it was lower, if you didn't lock in fixed or a scrap deal back here, I talked to people that did both of those. But if you missed that window, now you're probably in the follow the market type of scenario. I don't think the market is going to skyrocket and go up. So you're probably, best case scenario is kind of follow the market coming back down, wait till it starts to come, and then maybe you can leverage a bigger discount or something of that sort as it weakens. But that's kind of where you're stuck for contract mechanisms, things of that sort. Then I'll move over to plate. I kind of talked about this already, but here's the chart. It's getting softer, probably continue to get softer. If it breaks through this type of support, it's really hard to say how low it will go because there's not much to gauge it on. It already broke this lower point, which is kind of what we were watching, came down, sort of flattened up, rebounded a little bit, and now it's broken this last low point, which indicates to us it's really bearish because it broke this point. But now if you look, there's not really another low point to gauge on. So it could, in theory, be in free fall. And if the government spending doesn't happen, it will be in free fall. So those are kind of your risk to forecast for the plate side.
Don, quick clarifying question. When you say that you can use, you might want to use a contracting mechanism that follows the market, do you mean then the price for the contracting mechanism for the finished tons, the finished price per ton of steel, as opposed to using a scrap mechanism? Is that what you're advocating?
Yes, correct. Yep. So you want to use that hot roll coil number. I'm not entirely sure what the futures contracts look like, but I do know that was part of the conversation to push if I pull the hot roll coil. When this just started to tick up, the futures numbers were really high. So the mills were all talking, well, it has to go up here because the futures contracts are up here. Back here when these were on the downside and the futures were down around 600, they said there's no liquidity in the market. That's irrelevant. But on the upside, the conversation's a little bit different, obviously. I would be leery of using those as a hedge. Also, I think probably your best bet at this point is really just a straight follow the market index. Whatever index you want to use for pricing, you can use just about anything for a straight price mechanism if that's all you're looking for. They're kind of all the same.
Okay, great. Well, thanks, Don. I'm just going to share my screen now. So yeah, great. Thank you. I just want to point out some of the tools and resources that we have available here at MetalMiner. Let me just make sure I've got my screen set to pull that up easily. Here we go. And I'm just going to share that with all of you. There's a lot of things that we provide at no cost to anybody, so feel free to avail yourselves of that. Just put this here. We've got our free weekly newsletter, which I think is probably the single best place to get sort of unique insights. Sometimes we only publish a unique insight in the newsletter. So that's a good thing to kind of keep in touch with, if you will, on a weekly basis. It comes out on Wednesdays. Our insights platform is essentially what Nicole and I and Stuart and Don have all been sharing. People use that to track the market, to understand correlations, to identify hedging mechanisms, to time their buy, and to secure their long-term outlook. They use it for budgeting as well. If you're interested in that, just make sure you reach out to us. We'd be more than happy to share a demo with you. And also there's a few other reports that I don't really get a chance to talk about that I'm going to mention here now. We publish 10 monthly indexes around 10 different, I call them metal categories. So for example, we have a stainless steel MMI where we're essentially pulling in stainless prices and elements that feed that index from multiple data sources around the world and give you a global kind of inflation indicator. That's what these MMI reports are. We do them for aluminum, steel, copper, precious metals, rare earths, etc. So feel free to sign up for those. They give you a good indication of kind of, am I seeing this change in my pricing for these underlying commodities? And last but not least, we have a whole series of white papers or best practices in our best practice library. And actually, we have a new one that we're launching right before the first of the year. So feel free to grab those. Some of those are written, with our best experience and guidance of what we've seen over the years and things to kind of keep your eye on. And in particular, we have 5 best practices of metal sourcing. Stuart talked about one of those today in terms of splitting out the metal cost from that conversion premium. I don't mean the Midwest premium. I mean the conversion premium, switching your ingot into a material that you buy. That's one of the 5 best practices, but just want to encourage everybody to take a look at that. And with that, I thank you very much for your time. Sorry for a little bit of glitches in the beginning. Hopefully this streamed okay. And we wish you all the best and a Merry Christmas, Happy Hanukkah, Happy New Year, and we'll see you in 2024. Thanks so much.